We're going to keep it moving. It's now my pleasure to introduce Naeem Zafar, who will moderate a panel of lawyers, accountants, and investment advisors offering advice for international entrepreneurs today. Naeem is a teacher at UC Berkeley and Northeastern University and a serial entrepreneur himself, currently leading a company called Telesense. I'll let Naeem introduce the rest of his panel. Hey, Naeem, are you on?
I'm on mute.
We had to have one of those.
You got to have one of those, yeah. Well, thank you, Shannon. And my name is Naeem Zafar. And like you said, I am a serial entrepreneur and also a professor teaching entrepreneurship at many universities. So today, topic is formation, exit. What's new? What has changed? So we're in a new normal in which we are, the rules have changed. So I have assembled a panel here. So we have here Navneet Chugh, who is a lawyer, has a law degree and an MBA, and has been practicing law for 36 years. He's also head the Thai chapter in Southern California, a USC guy. And then we also have with us Dave Stevens. Dave has been running for 20 years the Stevens Law Group, and he is all about IP law, trademark, and anything to do with patents and anything like so. We'll have that knowledge, again, with a degree in electrical engineering and physics from University of Michigan. And then we have Gaurav Bhasin. Gaurav is a prolific blogger, as well as he's been at Allied Advisor for the last 2 years, Page Mill Partners before that. So he has seen a lot of transaction, a lot of M&As. So he has an interesting view and a current view on all what has changed. So gentlemen, welcome. Anything you want to add, which is something I should have mentioned, I forgot to mention?
You didn't introduce yourself, Naeem.
Yeah, thank you. I'm a serial entrepreneur. I'm a Thai charter member and founder and CEO of Telesense, a company in ag tech, ag as in agriculture. I've also been teaching entrepreneurship at UC Berkeley and Northeastern for the last 15 years. And I'm an angel investor and very active in proliferating entrepreneurship throughout the world. So I think we're going to have a lot of perspective. It'll be good to hear from everyone, and please send us your questions and we'll get to the questions very quickly. So the new normal, do's and don'ts, how things have changed. Let's talk about valuations, because, few years ago, if you got a 5 to 10 million pre-money for Series A, you were pretty happy. I think the rules have changed. There's seed, there's a pre-seed. Gaurav, start us off. What's new? What should people know?
Yeah, I think valuations, you're right. Everyone who opens the news today, you see a lot of financing taking place at, billion-dollar type valuations, huge funding rounds, exits, which are happening at healthy clip, good valuations, a good amount of IPO, good amount of SPACs.
Let's talk about early stage. What about early stage? Because many listeners are early stage. What kind of numbers are you seeing? What's normal? What will be strange?
Yeah, so just talking to investors, we don't get involved in early stage financing, but, investors are finding it very tough to get into the right deals. Investors who would get into deals at 6, 7x ARR at early stages are now having to pay 10, 15, 20x. I think the valuations have crept up quite a bit. And also what's happening is sort of a flight to quality. Entrepreneurs who have kind of built companies before, who have had success before, are finding it pretty easy to raise rounds at very, very frothy valuations. But by and large, the check size has gotten bigger and the amount of capital chasing these deals have gotten larger. So, investors are kind of in a good spot. The entrepreneurs, frankly, are in a good spot to kind of pick and choose the investors they want. So there's a lot of competition for good deals. So the valuations have gone up.
So I didn't get a single number out of you.
I've seen companies where, the revenue might be like $1 million and they're raising money at 30, 40 million pre-valuation, right? It just depends on the company, the sector and the stage. But by and large, valuations have crept up. Just anecdotally, people were getting into deals at 6x ARR. Now they're like 15, 20x or more. So
Navneet, let me switch to you, because your law firm does everything except divorce, I think, but heavily into corporate litigation. Tell me a little bit more about some of the instruments being used. What's new? Safe? What's the typical cap? What's the discount? What's new what people should know?
Well, given that the divorce rate in the Indian communities increased dramatically. Now we do divorces as well. I call them, we do CEO divorces. If there's a lot of money involved, then the divorce is actually more accounting and taxes than anything else. I think what has happened is, just to a final thought on Gaurav's valuation, what's happened is that there's $8 trillion of cash that these companies have accumulated because of the pandemic and defensive strategies, and of course saved a lot of money. So there's a lot of money floating around, and that of course is having a big impact on what investors are willing to pay. And the big buyers are actually the big companies themselves, and more money is spent by the big companies than the small investors or even VCs. The safe notes are not as popular as they were a couple of years ago. But still some of that is happening.
What is popular? What are people using to do early stage investing?
Back to the good old days, normal transactions and
price bound.
Yeah, and restricted securities. The vesting schedules haven't changed. Cliff vesting happening in almost every deal. But safe notes
for
are
founders and employees, you mean?
Yes.
Yeah. But cliff vesting was common before that. Anything changed recently?
No, nothing's changed. It's become even more common than before. Before you could argue standard vesting split over 3 years or 4 years. Now they don't even want to talk about it. If you bring it up, they're like, what generation do you live in?
So what's the new normal?
The new normal is chasing the right VC. So these early stage founders, they're saying no. They're saying no to 75% of the offers they're getting from VCs. So the tables have turned.
Sweet. Yeah, interesting. So it'll be interesting to see. Let me go to Dave Stephen for a second. Dave, you've been looking at IP, trademark. What's new? Anything changed which we should be aware of?
Yeah, well, the big thing since the pandemic is all companies, big and small, have lost their sense of humor about paying high legal bills, right? And there's nothing that scales up more quickly than investments in IP, in particular in patents, right? Time's the enemy. You need to file patents before you sell your product if you want foreign coverage. You get 12 months in the United States. And that's never enough time to get visibility on your product and your market. 12 months is just not long enough, right? So strategy is everything, right? The most important patents you can get are the ones, certainly that protect your product, but they also, the magic about patents is they can help you place risk in your competitor's roadmap. And those are the two places you focus on. Numbers don't matter anymore. You don't file hundreds of patents unless they're really focused on your product. There's no point in getting carried away, and you never get the value out of them anyway, unless you're in silicon, right? I mean, those are the types of areas that really get knocked off. They're very litigious. But even then, companies are scaling back and focusing on, purposeful protection.
So if I synthesize what I heard, what's new normal is fewer patents, more purposeful patents, and not just let's file 5 patents because that's going to get us funding. Is that what I heard?
That's right. And with SPACs, it's really interesting. We're doing a lot of SPAC work lately. And unlike IPOs, SPACs, they're piggybacking on companies. And when they're investigating them before they, do a transaction, they're looking more closely at their roadmap. What is your roadmap of value and increase, right? Because this company that's, strapping them on, they expect to get some value over long term. It's no longer, hey, make IPO and do the best you can. Worry about growth then. You need to proceed that more. And nothing shows that better than a roadmap of intellectual property. Here's a roadmap of our product, innovations, and here's how we're going to protect them. It's a certification of the improvements and new things that have never been done before over a period of 2 to 3 years.
So that's very interesting. Gaurav, let me go back to you. Did you heard some interesting and controversial things from panel? Any reflection on you, because you're a prolific writer on some of these topics? on
Yeah.
SPACs, on the use of SAFE, any new valuations?
Yeah, I think SPACs has been around for 20, 30 years, right? It had a little bit of an unsavory reputation. They've come back in vogue. A lot of companies, took the backdoor route to getting public through SPACs. These things are still remaining true about SPACs. The high quality companies like Airbnb had offered to go public via SPAC. It said no. For the wine lovers, Duck Horn went, through the traditional IPO route. I think SPACs have some advantage. You can go to market faster. But the SEC is clamping down on them. There was a lot of lawsuits with some SPACs like Nikola, which had zero revenue. They were claiming to have a lot of revenue in the future, and the market cap was frankly bigger than Ford. But then the whole company went bankrupt, right? And I think the SEC is not going to take this lightly. If you recall, in the 99, 2000s, there were a lot of companies going public, right? And then you start to have a flight to quality. You have to be a certain size of revenue. You have to have your accounting books and everything in order. You could go public. So, there will be more clamping down of regulation in the SPAC. But I think it also spurred innovation in the IPO market because, frankly, the IPO market is a very long and painful process. I've taken companies public before, and I think some of the innovation in SPAC is healthy. And frankly, I think it's going to be here to stay. There's a lot of late-stage growth companies that need liquidity. So either they have to go to another private equity firm, or they will go public via a SPAC. So but I think it's overall a positive for the market.
So Navneet, let me go to you on that, because one of the things you guys specialize is M&A, and especially cross-border M&A. What is new? What has changed? What should people know?
Yes, the first half of last year was not as well, not as good. And the second half, the M&A activities picked up almost 100%. And this year is going to look good from an M&A point of view. India has become, had become active, and now this pandemic increase in India will slow things down. And one of the best investments last year was the Indian stock market, up 60% in the middle of the pandemic, which was just shocking. And somebody posted that 6 more divorces and Mukesh Ambani will become the richest person in the planet. So that's how much wealth has been created in India. What's new with India in the last year or so is that India is in the driver's seat in a lot of transactions. And earlier, the US company parent would have a subsidiary in India and US would drive the transaction. And now we see transactions where the Indian parent is driving the transaction and the subsidiary is in the US. So the smaller component is in the US and the larger component is in India, which is great for India because India will finally get its fair share of tax from these M&A transactions.
Any pros and cons for the entrepreneur if the headquarter is not in US? I thought the tax law will favor if entrepreneur had the headquarter in US. Am I wrong?
No, you're not wrong. But these are Indian companies that are growing indigenously in India, and they came to US later. And so for them, earlier, if there were 4 founders, 3 were in the US, 1 was in India. Now there's 4 founders, and the last transaction I did, 3 were in India and 1 in US. So when the majority partners...
Yeah, and let's talk about structuring the transaction, because what used to be very common was earnouts. So right. Suppose you sold the company, you got 50 million up now, and next 150 million will come if you based on time and milestones. Is right. that most of the time you never got the earnout because you didn't have the control of the steering wheel. Right. What's your view now? What are you seeing these days?
The earnouts never going to die. Earlier, maybe there was a discussion that we won't sell if there's an earnout, but that's out. We know there is going to be an earnout no matter what. So the only discussion is the earnout 15% or 10 or 20 or 25? So the discussion is between 10 to 25, not between 0 to 100. Earnouts will remain, but we do negotiate that if there is an earnout, we will have significant control over how to run the company so that we are in the driver's seat a bit so we can control the earnout.
Got it.
Yeah, Naeem,
Dave,
I think if you look historically, 20% or 25% of transactions have earnout. I think the pandemic has kind of increased it because of the risk in the environment. So earnouts, to Navneet's point, won't go away. 1 in 4 transactions have them, and frankly, it's a way for drivers to drive value of the transaction post sale. And the devil is in the details, how you structure it. As far as achievability, I think both sides kind of want to achieve it. And also another thing just to kind of keep in mind is, duration should be short, a year to 2 years. And also the percentage of the owner should really be no than 10 to 20% of the total equity value or enterprise value rather. So
it's interesting what you said that
Naeem, the last transaction I did, the revenue was zero. It was just all IP. And so there was no earnout.
Yeah. So good thing about Gaurav, you're saying is that not all transactions have to have earnout. Only about 1/4 did, in your opinion.
Yeah. And, there's the ABA, which is the group of survey firm lawyers. They look at deals holistically. And that's on average, it's always been about 20 to 30% of them having earnouts. Yeah.
So, Dave, let me ask you another question. And audience, please feel free to send a question in the chat, and I'll be happy to ask your questions. Dave, I wanted to ask you one question about patents and trademark, because a lot of startups in the beginning, how much money should I spend? Because in which country should I cover? There are 212 countries. Obviously, it'd be silly to go chase them all down. How do you come up with a strategy that which 1, 2, 5? What do you advise to early stage?
Yeah, it's not entirely a game of kings, right? It can get expensive in foreign filing, and I don't mean India. India is one of the least expensive because you can file in English, right? The most expensive ones are ones where you need translations, right?
Brazil.
And it's been my experience, if you really look at the value of IP, and not many of these transactions do, I mean, like really look and read what patents have issued, what impact do they have, what revenue could they possibly generate. The early patents are the early ideas, and they're very broad, and they're often unproved. It's also very difficult to get broad claims nowadays, especially in the United States. The most valuable patents come in the implementation, because patents, inventions, are solutions to problems. When you take a problem and you put it in front of engineers, that's where the magic happens. And they'll solve that, right? The key is the right people have to choose what those problems are, right? Because the engineers will go after the most complicated thing because it's sexy, it's awesome, and it takes a lot of brain power to solve these. And it's very stimulating. The implementation patents are the most valuable because those are the choke points for the product that actually gets out there. And for products that get, customer feedback, whether it's B2B or even customers, you solve those problems. Those are the real products, real problem solved, real inventions. So don't invest too much too early, even in foreign countries. And when things normalize out after you've been out a few years, you're not going to file any more than 10 to 15% of your patents in foreign countries anyway, right? What's most important to save money is bring the inventions in and search them all, vet them. If you just file on everything, and they do this to save money, I'm not paying for searching, I'm going to file more patents. Bad idea. Most companies will cut out 40% just based on prior art searching. It makes these, not everything's patentable, right? Qualcomm, Walmart, all these companies I've done work for, the normal is about 40%, you knock them out with searching. You're saving 40% right off the bat.
Yeah.
So, yeah, you can save money and get meaningful coverage.
So guys, one question which came from the audience was about this Crosswater Companies. They're saying that what are the pros and cons that one founder is a green card holder, one is a US citizen. Now, should we put the headquarters in India versus US? Does it any pros and cons of that or no?
Yeah. So, I think most of the tech companies we work with generally tend to have a US Delaware C Corp with a sub in India. It just keeps it cleaner from a transaction perspective for the North American buyer. The reality is the premium buyers are still in the US. The premium investors are still in the US. Structurally, it just makes the transaction a lot easier, if you may. We have worked with companies where the entrepreneurs have had green card or they have been on visas. The bigger companies like Facebook, Google, and others will kind of port them and give them the visa. That kind of comes up really downstream in the transaction. The more important thing is, are they interested in the companies? Is something they want to acquire? And if they do want to acquire, then, structurally having the right structure, as a U.S. Corporation with a sub in India, along with then the people, they can figure out ways to kind of port them over and give them the visas they need to have. So,
Navneet, any addition to that answer?
Yeah, addition to that is that a lot of people now want to stay away from the United States because if they take up a green card and citizenship, then they're subject to US tax for pretty much the rest of their life. And so one way to avoid tax, worldwide income taxation, is to stay away from the US. So a lot of people we give up for our clients, we cut up green cards and surrender citizenships like we never have before. It's the rule, if you are in the US and you accumulate more than $2 million and you want to leave, the government wants 25% of it.
Of that, yeah, you gotta, as if you're paying, yeah. So that's so guys, we are down to last maybe 5-6 minutes. Maybe we can start maybe some final advice. You can shame it. What can early stage entrepreneurs do to maximize the value, building the company right? 2 things they should do and 2 things they should not do. If you can frame your question that way, it'll be very good for us to remember. What can they do to maximize the value as they start building the company? Anybody wants to go first? Dave, do you have some advice for us?
Yeah, be smart and strategic before you spend too much money on lawyers in general, and in particular, intellectual property lawyers, right? Be smart, don't overspend.
Got it. Gaurav, what do you think?
Yeah, I think, at the end of the day, whether it's M&A or investment, it's still investing in people and relationships. So early stage founders, should try to build partnership with the buyer groups because, it's almost them getting to know you will make a transaction more likely, especially if it's early stage, there's not a lot of revenue backing it. Same thing with the investors. If you're a seed company, try to build a relationship with the Series A type investors, know what sort of metrics they're looking for so that, when it comes time to it, they have you on the radar. You've kind of grown nicely, consistently, and then kind of try to create a feeding frenzy so that, different folks are interested in you and you can create that competition, which we discussed, which will drive your valuation. So I think those are some of the things, just, while you keep your day job, look outside and see what's happening in your space. Are your competitors getting acquired? Are they getting funded? That's change your dynamic landscape, and be out for looking to the next step of your journey.
So let me just dig down for a second on that. The difficulty is they say, get to know this Series A investors, get to know things. When you get to know them, you have like one chance to make a first impression. They want to know what you're up to. So you sort of blow your chance because you're not ready for them. You just want to get to know them. It's not a date. It's just like, hello, it's just a coffee. But in their mind, there is no coffee. It's a date.
Yeah, it's how you spin it, it's how you position it, right? I mean, you might be developing a product that's got, say, for example, Dave has done some good IP work for it, and that product could be valuable for Qualcomm. You could start with a commercial partnership. You're not going there and say, please buy me, right? You could go and say, this is how my technology can be valuable for you. Can we work with you as a partner? So this is what we should do. If you're going to investor, you say, you're a prolific B2B investor. You have invested in SaaS companies for the mid-enterprise or the SMB. By the way, this is what I'm doing. And this is where I will be in 12 months from now. I would like to develop a relationship with you ahead of a fundraising round. And by the way, we have raised money from, good seed investors. Some of these seed investors have their company, they've gone on to Series A. And in fact, they're the ones who introduced you. So, get those folks to make the introduction. It's how you position it. So this way, when you're ready for it, they at least know that you've been doing well. The flip side is you might tell them a year from now, I'll be at 3 ARR and you're at $1 million ARR. Well, hurt you. So, don't overcommit, under promise and over deliver. But, don't be you can't expect to walk into office and the first meeting from a date to a marriage, right? You got to be visible, raise your profile.
Yeah.
So.
Yeah, that's good advice. Navneet, any advice on do's and don'ts from your side?
Yeah, sure. I think the most important thing is to keep the structure neat and clean and not have some entity owned by some aunt or uncle, 5%, and the other entity owned by a group of other people. That's a huge problem. And have everything in writing and not that we will discuss it later, especially if there are more than one founder. So I think if the first structure is neat and clean and simple, I think the investors like that. And the IP is placed in the company that is being funded, and not there's another company for some other reason. So people come to me and say, well, this company subsidiary is owned 5% by my aunt and this and that. And I tell them, why don't we learn from the best companies in the world, the Microsofts of the world, that there is one company with subsidiary in 180 countries, and that's it. And sometimes people get surprised, but finally we're able to convince them. From an idea point of view, my last thought is that a lot of money wealth gets created with roll-ups, and roll-ups are very successful if they operate in fragmented industries. And no country has more fragmented industries than India. And I think the roll-ups in India is a multi-trillion-dollar opportunity in the next 50 years.
I think that's a good advice. I think roll-up is a very interesting opportunities. We only have 3-4 minutes left. There are a couple of questions come in. I do have a question before we go to this question. See, a lot of time you take friends and family money in the early days. Easy way to do that is a convertible note or safe. The problem is, then all these uncles and aunts and friends who know nothing about investing end up with preferred shareholder on the cap table. Annoying, or just put up with it? Any advice?
Put up with it. Like we put up with friends and family, we put up with their investments.
All right. And another question which has come in is it a better place to incorporate company these days if U.S. tax law is concerned? I think answer hasn't changed, but let me ask you.
The answer hasn't changed.
Sorry?
The answer hasn't changed, except for even though I sometimes prefer that people incorporate in the state they live in and incorporate in the state where their business is. But then the investors insist on Delaware. And you know who insists on Delaware more than anyone else? People in India. I get calls, I want a company in Delaware. And I'm like, you don't need one in Delaware, but they will not listen. So for India, it's very fashionable for their chit chat in the evening that, hey, do you have a company in Delaware?
Yeah, right. So gentlemen, we are going to stay on time. So I really appreciate, we didn't get to talk as much, but I think we got something out of it. Really appreciate your candor and your time and your participation. I'll hand it back to Sandeep from Blue Point Venture, who will introduce our next speaker. Sandeep.
Thanks, Gaurav, Navneet, Dave, and of course, Naeem. You just heard some great insights on what's changed from an investment banker, a patent attorney, a corporate attorney, and a founder. Great insights on what's changed, not changed, some good do's and don'ts. Thank you, guys.